Why shouldn't you invest in ETFs? Or maybe, why should you do so? The world of investing is rarely offering us things that deserve a definite yes, you have to invest in it, or no, better stay away from this advice. ETFs or exchange-traded funds are no exception. So what should you do with them? Let's try to find the answer together. What are ETFs? As you can guess, ETFs are funds that can be traded on exchanges. This type of financial vehicle is relatively new, but it's becoming more and more popular lately. ETFs are basically investment companies that allow investors to pool their money in a fund that invests in stocks, bonds, or other assets. In return, an investor gets an interest in the fund. But what's so special about them, and how do they differ from well-known mutual funds and usual stocks? The main feature of ETFs is that they can be traded throughout the day just like stocks. But unlike stocks, the number of shares of an ETF can also change daily. That helps to keep the market price of an ETF in line with the underlying security. Also, ETFs are usually designed to track the value of an underlying asset or index, not to beat the market. That results in more passive management and lower risks. Still, ETFs are not all the same. First of all, they can differ in structure and be cash-based or swap-based. Secondly, they may passively track indices or be actively managed. However, the most obvious difference between particular funds comes from the type of assets they are based on. On the exchanges you can find stock or equity funds. They are usually tracking indices, broad ones like Wilshire 5000 Total Market Index, or more narrow sector indices like S&P 500 Energy Index. They are considered good for long-term investments. Bond or fixed income funds. While the fund invests in actual bonds and deals with maturity dates, by investing in that fund you get all the bond stability and regular cash income without time limits. Commodity funds. Through those, you are investing in physical goods, such as gold or agricultural products. A commodity ETF can either focus on one specific commodity and actually hold it somewhere in storage, or deal with commodities' future contracts. Such funds make investing in commodities easier and offer a good option for diversification. Currency funds. These ETFs give you access to foreign exchanges or currencies. They are used mostly for hedging purposes. Now, when we've got an understanding of how ETFs work, let's go to the main part. Why should you invest in ETFs? They are good for beginners. No need to choose between different stocks and investing strategies. Following indices is both a safe and effective approach, but doing this on your own is quite a challenging task. ETFs, meanwhile, can give instant access to a basket of assets that would be very hard to collect for an individual. Exchange-traded funds are enormously useful for diversification purposes. They can connect you to a selected industry or a whole sector, to a specific commodity, or a large portfolio of bonds. Just picture this: by buying shares of an ETF that follows an S&P 500 index, you can invest in stocks of 500 of the biggest US companies. ETFs are traded like stocks. You don't have to wait till the end of the day to buy or sell a share. Moreover, you can buy on margins, sell short, use options and futures. And all of this with the benefits of a large assets basket. Lower fees are also an appealing aspect of investing in ETFs, especially when comparing to mutual funds. Following indices doesn't require active management with a lot of decisions and transactions to make, so it results in lower expense ratios. Plus, from the investor's side, the broker fees are paid only when buying or selling a share of an ETF. And what about disadvantages? Are there some reasons why you shouldn't invest in ETFs? Yes, especially when you are ready to take bigger risks in order to get bigger returns. If you are not a newbie to the stock market, you might want to choose individual stocks over ETFs. In this case, your profit could be bigger if the selected stock performs well. Plus, you don't have to pay fund management at all. While in general ETFs seem quite attractive, there could be a list of cons when it comes to a specific fund. Not all ETFs are passively managed, so you might face higher fees. If you choose a narrow one industry or a niche ETF, you'll have to deal with increased volatility. ETFs that invest overseas are prone to currency fluctuation, and there could be extra taxing. Some ETFs are not traded frequently, so instant selling could be impossible. The bigger risks, though, are that your ETF will suddenly close or the followed market will drop. In this case, you'll lose money, that's for sure. But let's be honest, is there any investment that can actually guarantee you that it will be here forever and always on a rise? So if you choose to invest in an ETF, just do your homework as usual. Take a look at the fund's fees and history, read the documentation, and check the underlying index. ETFs are a good place to start and can be a good long-term choice for those who don't want to pay too much attention to their investments. That's all for today's video. I hope you find it interesting and helpful. Let me know what you think about the exchange-traded funds in the comments below. Thanks for watching and don't forget to subscribe so you don't miss any of our new videos.